Dear listeners, welcome to Mark's Morning Call, real time, real markets.
Hey everyone, welcome back. I'm your host, Dr. Jennifer, and with me, as always, is our amazing financial guy, Mark.
Good morning, everyone. Looking forward to it, as always.
Today, let's talk about the PE ratio, price to earning ratio, which probably the most widely used stock pricing tool. Because this morning I came across some interesting news. A well-known investor mentioned that Warren Buffett's company, Berkshire Hathaway, looks relatively cheap, and he planning to buy some more of it. A lot of my students ask me, Jennifer, why $727,000 per share is not expensive? Isn't high prices expensive, low prices cheap?
Great question, and it's one that's asked very frequently. Bear in mind that the price is what you pay for one share. With Berkshire Hathaway, at those prices, that entitles you to one share. However, it is impossible to know whether that's a good price or a bad price until you know what you're actually getting for your money. Remember, previous episode we discussed that comparing stock price among companies are meaningless because you don't know how many shares there are in the company. It may well be that when you buy a share that's got a very high price, then you're buying quite a high percentage in that company, because all companies have different numbers of shares issued. There's no rules and regulations about it. So the important thing is that you're buying the right to one share. What does that right entitle you to? Well, it entitles you to the earnings of the company in the future, as long as you are the shareholder.
Quite right. I always tell my students why it is called a share, because you have a right to share their profit in the future. Now, since you are in the UK, I was curious. AstraZeneca's price seems quite high at 11902 GBP. Is that the highest price in UK market?
Yes, it is the most expensive stock in the whole of the FTSE 100. But be careful with UK share prices. Typically in the US, when you look at a share price, it relates to dollars, whereas in the UK it's a little strange because GBP is actually GB pence. So with AstraZeneca at nearly 12,000, that is 12,000 pence, not 12,000 pounds. To get the pound, we have to obviously divide by 100.
So it's around 119 pounds per share for AstraZeneca.
Exactly. That's exactly right.
Okay, now I got it. It's a bit tricky. If I don't know UK market, I would think, everything's quite high prices.
Exactly.
Okay, so if the share price doesn't tell us about exactly how much value of the company, what do investors really mean when they say a stock is relatively cheap or expensive? How do they know that?
If you remember a second ago, we said that if I buy a share at the share price, it gives me the right to the earnings of the company in the future. So as a result, we know what we have to pay. It makes sense if I then compare it to what I get for my money, which is the earnings. So this gives us the really crucial measurement used widely by all investors, which is the price earnings ratio. We are looking at the price in relation to the earnings of the company. And once we've done that, we can really start then making sense of whether things are expensive, things are cheap, and whether we want to pay that price.
Okay, so we promise our people that we are not going to be mathematical. I still need to give a small example.
Let's just do a historic calculation. Today's price against historic earnings, which is the standard calculation.
Apple now is trading at $226 per share. And 2024, its earning per share is around $6. So 226 divided by 6, it's around PE 37.
As we said a moment ago, the price is what I pay. It gives me the right to the future earnings. So if I've got one Apple share, then that gives me that right to $6 earning per share. So as a result, what we're saying is that I am prepared to pay at the current share price 37 times those earnings.
So $1 profit of Apple worth $37 today in the market.
That share gives me the right to those $6. But you can see from the calculation, or just trying to make sense of it, that means that if I pay my 226 and I get 6 back each year, it's going to take me 37 years to get my money back.
Wow, that's a long time.
So it seems a very long time. So it's an important point here because no sane individual would possibly wait 37 years to get their money back. So this is the really crucial point about why some PEs are very high and some are much lower. Because no one really believes it's going to take 37 years. What they believe is that this year's EPS is not representative of what it's likely to be in the future. So if we think about Apple, fast-growing company in the technology sector, we expect them to grow those earnings every single year. And so as a result, next year maybe 8, the year after that maybe 10. And so as a result, we're not going to have to wait 37. That period is going to get shrunk dramatically as their earnings grow.
So that means if anyone now going to buy Apple one share at $230 something, they're paying 30 times of the earning. They must have expected a high growth of the Apple business in the future. Now it makes sense.
If as investors we thought all companies weren't going to grow earnings and that their earnings today were going to stay the same, then obviously we would just buy the lowest PE company because that would get us our money back in the fastest possible time.
Well, you say lowest PE company, let me check my Perplexity AI. I found in UK market that HSBC's PE is currently around 10, while AstraZeneca we just mentioned is 19. So compared with Apple's 37, what does those low PE exactly mean in their context? Does it mean HSBC no growth?
Yeah, I mean, exactly correct. So with HSBC, again, just applying the same logic we did with Apple, then trading on a PE of 11, then it would take us 11 years to get our money back if the earnings stay the same. So we would then think to ourselves, right, if I get my money back in 11 years, that's not too bad.
I feel pretty safe. I'm happy with HSBC.
When someone likes HSBC, we're not expecting them to grow dramatically. Then they operate in a number of kind of areas that don't have high growth. As a result, we'd probably think that seems reasonable. They're a big company, a safe company, so they can probably kind of stick with what they're doing, maybe grow a little bit, but not dramatically. And then AstraZeneca, probably somewhere in between the two. As you said, it's got a PE of 19 times its earnings. So I wouldn't think of a pharmaceutical company as dynamic and have the same opportunities someone like Apple in high tech. But nevertheless, it still has significant opportunities as it develops new drugs. As a result, market is saying that the growth opportunities of AstraZeneca are somewhere in between Apple, fast growth, HSBC, quite sluggish growth, and AstraZeneca, let's kind of plonk somewhere in the middle.
I think it explained what I read yesterday. Recent memo titled Bubble Watch, investor Howard Marks. He provided very interesting PE ratio comparison. He separated giants out of all the other US S&P 500 companies. They call them Magnificent Seven, including Apple, Microsoft, Alphabet, Google's parent company, Amazon, Meta, which is Facebook, Nvidia, and Tesla. So these 7 firms together, they trade at average PE about 33, while the rest, as I said, 493 companies average at 22. So the growth explanation play a role here?
Huge. When we're looking at the 7 companies that you identified, which have now been called the Mag 7, they are very dominant in terms of just their size, but also they're all in areas of technology that reflects the fact that they're all deemed at the moment with AI, in particular right now, to have great growth opportunities. Their PE is almost inevitably higher than the remaining S&P 500 because the remainder is much more like banks, pharmaceutical companies, consumer staple companies. As a result, it's deemed, and probably correctly by the market, that they don't have the same growth opportunities.
But sometimes I really see crazy PE over than 100. BP's PE is 200, super high compared to those tech, even Magnificent 7.
Well, a good question, actually. And it's really two issues that investors need to kind of keep an eye on. The first one with BP. Now, BP is an oil exploratory company, and you wouldn't really necessarily think of that as kind of super high growth like in tech. So that 200 is a bit of a quirk. BP is going through a huge kind of restructuring exercise at the moment. And so as a result, it's incurred lots of costs that it wouldn't necessarily incur on an ongoing basis. And so in BP's situation, I would just say that the 200 is kind of meaningless.
Maybe it's alert. You have to check what's happening, something happening.
Yeah, the more interesting ones are these companies that the market gets really excited about and the PE ratio then becomes massive. Tell you a great example if you want to do some homework on this. If you go back and look at the historic PE of Nvidia, you know, how crazy PEs end up making sense. It's a great illustration. And if you put the PE bands in, I guarantee you at its peak, Nvidia was probably trading at historic well over 100 times.
2023, 57 to 112. 2024, up to 50. And
Yeah.
now 57 or 59.
Yeah, it got over 100 times.
Sounds like the perfect research project for you, Dr. Jennifer. If you could take Nvidia's very high PE ratio, around 100 in 2023, and work out what kind of earnings growth the market is expecting, we can then compare it to Nvidia's actual earnings growth. If Nvidia's real growth is close to or even higher than what the market expects, then the high PE might make sense. In other words, the market's optimism could be justified. Why don't you dig into it and share your findings with us in the next episode?
Absolutely. Sounds a very interesting project and very useful project. Let me do it this weekend. Okay. Mark, let's wrap up. If you had to give us one takeaway about PE, what would it be?
It's really around how we use PEs, and there is a number of really important things that we can look at. So what we said is that we've got
Our steadies.
HSBCs. So we might compare HSBC with other steadies. We might look at Lloyds Bank, Barclays Bank, NatWest Bank, because we know that they pretty much do the same thing. And so as a result, in comparing price and value, then if we categorize those companies together, then the relative price makes sense. The next thing I would take away in thinking about what you want to include in your portfolio is that very high PEs don't necessarily mean that you don't want to include them, because there are plenty of companies that have got such huge growth opportunities where their current earnings really bear no resemblance to what may occur in the future. And so if you find a company that you think looks expensive, always make sure that you have an assessment of what that future earnings are going to be, because the growth in that earnings can eat up that PE very quickly if they're growing very, very fast. I guess the last ones are the crazy ones where the PEs just seem huge in the hundreds. Then you really have to be pretty sure that they're actually going to be an amazing company in the future to justify buying those shares.
Great advice. Personally, I love HSBC. 11 years, get my money back.
And you
Got a 7% dividend yield. Lots to like.
Final reminder, this podcast is for education only, not financial advice. Our views are our own, and investing always carries risk. Please do your own research.